Hey everyone, welcome back to the channel. Today we're diving into a lecture that separates experienced traders from those who are just getting started. Higher time frame institutional order flow. Now, this isn't just about guessing where price will go. It's about understanding what the market is trying to do and, more importantly, who is behind the movement. By the end of this video, you'll have a structured understanding of how institutional order flow operates on higher time frames, how to read it, and how to align your entries in sync with it. So you stop fighting the trend and start trading with it. Order flow, in the simplest sense, is the movement of price driven by buying and selling. But when we talk about institutional order flow, we're not talking about random retail buying or Reddit driven hype. We're talking about sustained, deliberate positioning by institutions. We're talking about banks, hedge funds, or entities with billions in capital who need to scale in and scale out over time. They don't place one big order, they accumulate and distribute, and they leave footprints. And those footprints are what we're learning to read. Now, to track that, we zoom out. We look at higher time frames, monthly, weekly, and daily, because that's where these big moves begin and that's where these moves end. I call this the MWD Framework. Now, why do higher time frames matter? These time frames give us context. Think of it like zooming out of Google Maps. You can see the road, the turns, the possible destinations. Without it, you're just driving blindly on a local road hoping for a sign. On lower time frames, you'll often see noise, fakeouts, and volatility. But when you're in alignment with the weekly or daily bias, those fakeouts become clearer. You'll know which ones are traps and which ones are the real moves. Institutional traders aren't placing billions based on a 15-minute candle. Their bias is set over weeks and sometimes months. And that bias creates the dominant direction of the market. So how do you read this? Start with the swing points. Now look at the weekly and daily chart and identify the recent higher highs and higher lows, or the lower highs and lower lows. This basic structure already tells you a lot. Are we trending? Are we in a range? Are we reversing? Once that is defined, you need to then search for liquidity. If price is pushing towards equal highs on the daily chart, that is a magnet. There are stops above, and these institutions or the algorithm loves these stops. They represent guaranteed liquidity for them to sell into or buy from. Now, what else can you look for? Displacement. These are strong impulsive candles, especially ones that break a structure level. That shows force, and force means someone with size is stepping in. Then watch how price reacts on the retrace. Does it respect the fair value gap or the order block from that impulse? This confirmation isn't just random, it's deliberate positioning, and the retrace is an opportunity to ride the second leg of the move. This was the move I called live on my Twitter, and this was exactly what I used to identify this price action. We have an impulse move or an aggressive expansion from this swing point. We have a nice fair value gap here. Price retraces into the fair value gap. We have a liquidity sweep below these lows, which triggers sentiment to be bearish. Once we have a bullish close or a change in state of delivery, I gave out the call that price is just going to move higher and Bitcoin will melt faces once again. And it did. I did alert this move in my private group as well, where I called out Bitcoin and we moved across to $120,000 from here, right? So it's a really nice move of over 50%, right? Now let's say on the weekly chart, price makes a clean push above equal highs, right? We have a large full-bodied candle that breaks structure. Now we've taken out liquidity and we've broken a major high. This shows strength. Then on the daily chart, price retraces into the imbalance or the origin of that move, the order block, which is this one right here. Now maybe it's a bullish down close candle sitting right below the breakout. And this is where you form your bias. Now the lower time frames are just tools. You're not trading them blindly. You're waiting for confirmation inside the daily zone, like a short-term market structure shift or a change in state of delivery or a fair value gap there as well. Now your trade is in alignment with the institutional order flow. Let me show you how that looks like on the daily chart. So on this particular move, we have price that moves lower and takes out sell side liquidity. At this point, you're looking for a bullish change in state of delivery because the high time frame institutional order flow is bullish. You look for a liquidity sweep, which we have that right here. You look for a formation of an order block or a change in state of delivery. You can have this particular level as well if you're trading based on the last down close candle, but that is not the true order block. The true order block are these series of down close candles. So right here would be where you position yourself long, which is exactly where I told you. And price moved higher with giving little to no retracements. And that is exactly what you want to see. Now you can talk about order flow as a simple movement of price driven by buying and selling. But that doesn't mean that price is just going to move higher all the time. It's going to give us opportunities to enter. As you can see here, we have a nice fair value gap as well, which broke the structure high. Price retraces into the fair value gap, moves higher, but price is not done with it. It moves lower once again, takes out the stop, moves higher, and does it once again. Now this is occurring because there is a higher time frame narrative in play, and until and unless time is met with price, there's no reason for price to move higher. Now price sometimes isn't just trending, it's consolidating as well. Now should not mistake this absence of order flow. Institutions are still operating, but they're just trading inside a range. So when price starts ranging, especially after we take a higher time frame liquidity pool, accumulation starts to occur, which means price is engineering liquidity at the highs and lows. Now eventually you will see a fake move in one direction and then an explosive displacement on the other side. The fake move is called a Judas swing. What that means is price moves lower while it takes out all the liquidity while targeting the consequent encroachment of this fair value gap. We have resting liquidity above and price smashes higher with displacement. So if you've been tracking higher time frame order flow, you'll already have a directional bias and you will not be shaken out by this move right here, because now you know what's real and what's not. So let me give you a simple 3-step approach to track higher time frame institutional order flow. You first start with a weekly chart. You mark out swing highs and swing lows. Then you ask yourself, is price reaching for the previous week's high or is price reaching for previous week's low? This gives you a clear bias, and especially when the weekly chart is clear, you have nothing else to worry about. Then you drop down to the daily time frame and you identify fair value gaps, order blocks at premium and discount. Now when price reaches this level and it is in line with the weekly previous week's high or low direction, you can now drop down to the lower time frame for a precision entry. You can wait for structure shifts. You can wait for a fair value gap to form as well in the same exact direction as the weekly draw. For example, if the weekly is bullish and the daily retraces into a bullish order block, you're looking for longs on the 15-minute or the 1-hour time frame. That's how you procure clear clarity in these markets. Now the truth is, most traders lose because they trade against higher time frame order flow. They don't even realize it. They see a short-term setup and enter only to get wiped out by the higher time frame move they never saw coming. But once you begin tracking the higher time frame narrative and you start following the path of institutional intent, everything becomes clear. You'll enter with more confidence. You'll be able to hold trades longer. You'll also stop reacting emotionally to every wiggle in price. Trading isn't about predicting, it's about aligning yourself with the market. So take your time, mark up your charts, build your bias, and trade with purpose. If this helped you build clarity to higher time frame order flow, drop a like and let me know in the comments if you want more lectures like this and what topic you want me to dive into next. If you haven't already check out the full crash course playlist I've made where I break down every concept one by one with real chart examples. And thanks for watching and stay disciplined, stay sharp, and I'll see you in the next one.